Apollo Tyres gains after 2.25 crore shares or 3.5% equity change hands on the BSE via large deal. Warburg Pincus White Iris is likely to be the seller in that large trade. The stock now trading more or less flattish.
The industry surges despite a slow quarter on bullish management commentary. The company is eyeing 15% revenue growth with sustained improvement on profitability. Expects new launches to drive growth. The order book also solid at nearly $1.75 billion.
BHEL slumps over 4% as the earnings miss estimates on all fronts in the fourth quarter. However, the yearly order inflows remain strong and the order book is at a decadal high. The management expects 12 to 15% revenue growth in the medium term.
JK Tyre surges over 5% after the margins improve nearly 300 basis points for the fourth quarter. Profit is up 55%. The net debt also continues to decline. The management tells CNBC-TV18 they expect 8 to 10% growth in FY25, which is higher than the industry.
Hitachi Energy gains on the back of a solid set of numbers. The revenue grows by 27%, driven by solid order execution and diverse revenue mix. The management tells CNBC-TV18 that they undertake price hikes to offset the rising metal prices. The reason that the numbers were good was that they attained the double-digit margins in FY24 versus the earlier guidance of FY25. Hello and welcome to Chartbusters. I'm Nigel D'Souza. Joining me as always is Mangalam Malu. And as we speak, it's a quiet-looking screen. The Nifty is up closer around 20 points. The mid-cap index, well, pretty much even Stevens out there. But Mangalam, yet again, the Nifty Bank. That's the one that's dragging the index today. And it's holding around the 50 DMA as we speak. In that band of 50 to 20 DMA, for the time being, it's flirting with the 20 DMA.
Problem pocket, Nigel. That's the Nifty Bank down about 0.6%. And the second half, we'll have the Nifty Bank weekly options expiry play out as well. So let's see whether it sees some support here or not. But no real problems for the Nifty. Yeah. If you look at the intraday chart of the Nifty as well, opened mildly in the green. Thereafter, there was a bit of a slump led by the Nifty Bank itself. And that slump has been bought into immediately, telling you that 22,500 seems like an important support psychologically as well for the Nifty itself. The mid-cap index, again, even Stevens for the broader market. So let's see where we go from here. A bunch of stocks actually doing extremely well. Positive commentary coming in the conference call of BEL, and that's taken the stock around 7% higher from the lows. In fact, now up around 2.7%. The management's spoken about improvement in their revenue, improvement in their margins, as well as the order book that they're getting. So that stock is at the high point of trade. We're also seeing some traction in names like Samvardhana, which is up around 2.5% from the lows. Dixon Tech too has recovered from the lows. And we're seeing a decent traction in Oil India as well, which was in the red for most part of today's trading session and has now recovered. Also, some traction is what we're seeing in FMCG names. After doing nothing, virtually nothing for 4 years, Nigel, Hindustan Unilever seems to have picked up. In fact, this month it's up around 6%.
Looks like the elephant wants to dance.
May want to dance.
May want to dance. Big underperformer, Mangalam. Yes. Everyone talks about, we have made so many returns in the market. We invested in mid-cap stocks. And then a value investor would say, I've got HUL in my portfolio and I'm holding on to it for the last 2 years with no return. So, but it's a high pedigree company. You'll know more about the fundamentals out there. But for the time being, it appears around that 2,200, I think, as well. It saw a lot of buying interest when the other majors started delivering positive numbers. So let's see how that goes.
Let's see how that goes. Everything is pinned on how the rural market outperforms. And internally as well, for Hindustan Unilever, one of the big triggers from the first quarter would be the reorganization of the business that they're doing. Beauty and personal care turns into beauty and wellness and personal care. Both these businesses having around half of the sales that they have currently. So we'll keep an eye out on that one as it pans out. At peak, it was at pretty high valuations, and now valuations too, because the underperformance have come in a lot more comfortable. But let's welcome Jay Thakkar of ICICI Securities for a quick technical check on the market. Well, Jay, what are your thoughts?
Hi, good morning to you, Mangalam. Good morning to you, Nigel. Well, as far as the index is concerned, it's trading around the 78.6% retracement mark. Amounts of the previous fall, which we saw from 22,800 to 21,800. So yes, stuck around the levels of 22,600. Really needs to take off those levels in order to inch towards those all-time high levels. So about 22,600 will definitely see the all-time highs. There will be high probability. Else it would consolidate within this band of say 22,300 to 600. The Bank Nifty, which you also pointed out, is struggling to gain momentum on the upside. It's still trading within that very small range of 48,500 to 47,500. Whichever side it breaks out should eventually get the momentum. But then mid and small cap indices. I mean, they've been doing good. So overall, as far as indices are concerned, Nifty and mid and small cap are looking really good. But I have two buy recommendations, Mangalam, today, both from the index heavyweight. One stock which you just mentioned about, that is HUL. I mean, after a long time, we are seeing some good momentum, some short covering happening out here. I think that HUL on the upside can see the levels of say 24.20 to 24.60 in the short term. These are the futures levels. I would recommend at these levels one can place a stop loss below 23.25 and go long on HUL futures. Overall chart setup indicates and derivative data also indicates there should be a good bounce here on. And Reliance, the second heavyweight from the index. I mean, that's contributing well in today's move of 50 as well. I think Reliance seems to have formed a short-term bottom at these levels now. Mangalam, I think, is inching towards 2980, 3000 levels. So those will be my short-term targets. On the lower side, one can place a stop loss at 2885 and go long on Reliance as well.
Okay, all right, Jay. Thanks a lot for joining in and giving us all of those details. Well, I'll tell you what, we'll slip into a short break. When you come back, we'll turn our attention to the IPO market. We've got a new kid that's going to be on the block soon. So we'll get chatting with the management on the other side of the short break. You stay with us.
Welcome back. You're watching us here on Chartbusters. It's the workspace solution provider, Office Space Solutions. Near 600 crore rupee IPO opens today for subscription. Amit Ramani, who's the chairman and managing director of the company, now joins us to discuss their plans post the IPO. It's an IPO, a near 600 crore IPO, of which fresh issue, Amit, is 128 crores. We see you using about 42 crores for setting up new centers and 54 crores for meeting working capital requirements. Now, for those who are in and around the city of Mumbai, would obviously know a lot of your office co-working space products, but generally co-working space, a lot of people know about what they are right now. What we don't know yet, or what needs clarity, is do you really own the office space that you lease out, or do you lease the space to sublet it to all those co-working guys? I just wanted to understand, your business model. How much of the land that you have right now is owned by you? How much of it is rented? What's the delta here?
So Mangalam is a completely asset-light model. I think it's a one of a kind that we have developed in the industry. We call it managed aggregation, wherein the asset, we partner with the landlord.
Okay.
Typically, we go out for about 35 odd thousand square foot is the average size. And with that, what we tell the landlord is that the new capital towards the fit out or upgrading the asset will come from them.
Okay.
Right? After a period of no minimum guarantee, let's say 5 to 13 months, we then do a profit share or minimum guarantee, whichever is higher. So completely makes it asset light. And then we have completely changed the demand and supply mismatch because there's no fixed rental.
So you don't give any fixed rent, but of whatever you make, there is a share that goes to the...
That is correct.
All right.
So it's the biggest challenge that was there in the global co-working markets was the asset liability mismatch or the demand and supply mismatch. So we've solved for that.
And what is typically the spread? The difference between what you get and what you have to give to them?
So typically we would share back with the landlord after covering the operating expense, 65 to 70% of the profit goes to them and the remaining comes to us.
All right.
Got it. Hi, Amit, and thanks a lot for coming down to our studio. First of all, congratulations. It's going to be a big moment for you as well as your team as you'll move towards listing on the exchanges. A couple of details then. Part of the proceeds that you're raising is going to be used for working capital requirements. So how does it help you all, if you could quantify that? And also around 42 crores will be used for setting up new centers. How does that work? What is the cost of setting up a center? And how does this help this 43 crores? How many number of centers or how much of incremental space do you get?
Yeah. So, Nigel, when we started the business, we were primarily co-working. We then expanded our portfolio to add what we call as design and build as part of our office transform business. And that business, basically, we would go to a customer and they would have their own space, they would rent it, but we would fit it out and give it to them as a service, right? So that part of the portfolio requires some working capital, and that's where the working capital is going to be used. The other 42 crores, which is towards the capex, we have positioned about 12 odd centers that will happen with that capital. Total view is of about 45 total centers for FY25. And out of the 12, 8 centers are in the model that I explained, which is managed aggregation. 4 are going to be straight lease centers.
Okay.
And as a result, Nigel, typically if it would cost me, let's say about ₹1,00,000 per seat, because in majority of the cases our landlords are putting in the capital, my cost of overall capital requirement is half.
Okay.
So it cost me ₹50,000 a seat. So that's how the blend of that 42 crores is going to be utilized.
So
you know who can't use this model, Mangalam?
Us, because ₹1,00,000 per seat is the seat will sink.
₹1,00,000 is the cost of putting the seat, right? But it costs anywhere between ₹8,000 to ₹12,000 a seat on a month, per month.
Those are numbers that
I meant because we have to come to the studio.
And in fact, CNBC is a customer. So.
we definitely sit in no. We're just kidding. But from what I understand about your business right now, there are 3 vectors of growth for you. The first vector, of course, would be you increasing the space that you have in terms of leasing the number of seats that you have. The second vector would be the existing seats getting utilized a lot more. And the third vector, of course, would be you increasing the yield that you get per seat. So can you give us a sense of all these factors, where they stand right now and where will they be, say, in the next 2 to 3 years?
So without commenting on exact growth numbers, but if you look at our growth over our centers, our cities, our number of seats, FY21 till December 23, average of 50% CAGR.
Okay.
Right. So obviously,
and the number of seat additions.
That's correct. Right. We have today 1,05,000 seats across 169 centers, 16 cities, and 52 micro markets. There's rarely a place in Mumbai that you wouldn't find us today, right? 20 plus locations for us in Mumbai. In terms of the yield, the longer term contracts have a 5 to 7% increment built into them. So these typically would be, let's say, 1 year or longer contracts would have them. Today the average tenure is 33 months. And the locked-in tenure is 23 months with our customers. So a lot of visibility on revenue and visibility on the yield that we would get.
What is the yield typically of the value of the land that is there? And
so of the asset, our partners would make anywhere between about 7 to 8% yield.
Got it.
Right? For us, obviously, it's a revenue to us, but the asset owner will typically make 7 to 8%, and on the new fit out that they would put in, they would make about 10 to 12% return.
Okay, couple of more factors then. The business model looks good. You have a great idea, all appreciated. But the stock market looks at one thing, financials and profitability. So will the company turn profitable in the coming year? Point number 1. Point number 2 is, what does the promoter holding come down to post this IPO?
So, Nigel, you have to look at where we have come from, right? 75% has been our revenue growth over FY21 to December 23, right? As I mentioned, 50% growth in terms of seats, cities, and our chargeable area. If you look at our overall number, right, it's about 616 crores for the 9-month period, right? It's come from FY21, we were negative 20%. Today we are only negative 3%.
Let's not talk about FY21 because that was also immediately post-pandemic, right?
That's
so on
correct.
that base, everything will be looking phenomenal. Let's talk about steady state numbers.
So Mangalam, today we are negative 3%. In actual hard numbers, it's negative 18 crores.
Okay.
The EBITDA today is 195 crores for the 9-month period. The cash EBIT is 67 crores positive.
So short point is you will turn profitable in the coming year, right?
I can't comment on it, but
that's
we are headed in that direction.
That's the direction.
Well,
Lovely.
headed in the
so
direction.
that point is out of the way. This market loves numbers. And on listing, we'll pull out a few from you as well. But tell us, what about the promoter holding? What does it come down to?
So currently I have 18.1%. It will come down roughly to about 17%.
And the entire promoter holding is around 41.
So we did not have, we have a 20% lock per SEBI. So we had to ask Peak 15 Sequoia to basically put in their shareholding. So they have put in about 3.5% as promoter shareholding to meet that 20% cap. And as a result, they are being tagged as promoters.
Okay.
But technically, I am the only promoter.
So then at some point, Sequoia will also have to, offload their residual stake?
So Sequoia, as part of this offer, is offloading about 66 lakh shares, which is roughly about 11%. 1.5% they've done a pre-IPO with White Oak, and the remaining 10% they will offer as part of this IPO.
Right. And we've also seen an increase in the number of agreements terminated by either clients or the company itself. I mean, I'm looking at this number. For the first 9 months, it's 326. The previous year, it was around 439. How does this work? What's the churn? Why do companies pre-cut their long-term contracts or something of that sort, foreclosures?
So Mangalam, we are workplace as a service, right? Clearly, somebody can use me for an hour, right? And somebody can use me for 5 years, right? So I have today 2,300 client companies that are resident with me, right? From somebody taking 1 seat to somebody taking 2,000 seats, right? Currently, the churn is about 1.2%, right? Which is what you would see in some of the largest REITs as well, right? Average about 15%. So I think churn for us is healthy, right? It's like the airline or the hospitality business, right? Clearly, the first guys coming in take the chunk, right? And they clearly take the bulk of the discount, right? But when the occupancy reaches at a certain level, churn helps us because we are able to increase the
What's your
yield.
overall occupancy right now?
So overall blended from a center gone live 1 day old to, let's say, from the inception is about 71%. And for 12 months on older center blended is 83%.
What do you typically break even at?
So in our model, as I mentioned at managed aggregation, I only have to first, when there's no MG, I have to only cover my operating expense, which is 25%, right?
Okay.
Operating expense is roughly 20%, is consumables, utilities, and manpower, and then common area maintenance. Beyond that, when our MG kicks in, and today in 50% of our centers, which are in managed aggregation, there is no MG, right? When it kicks in, it's usually 50% of the market rental. So at 45%, I break even. Straight lease, I have to get to about 65% occupancy.
Okay, all right. Pleasure talking to you. Thanks a lot for joining in and giving us all of those details. We look forward to the listing day, and then we'll get you back on the channel. For the time being, we wish you well, and thanks for joining in and explaining the model to us. Well, for the time being, guys, I think what we'll do is we'll slip into a short break, come back, continue our focus on markets with news that the Nifty Bank is is the one that's under pressure. So we'll have to see whether or not the bit of a bounce is due. Stay with us. Welcome back. Well, if you just pull up the chart of the Nifty Bank with the 20 and the 50 DMA, that's giving you a proper picture. Because as we speak, the Nifty Bank is at the 50 DMA. That's just a vanilla chart, but we'll try to plot the 50 DMA with that. We'll tell you why exactly, this is a very, very crucial mark on the Nifty Bank, 47,700. That's the line in the sand. You don't want it to break decisively. There it comes up for you on the screen. We're at that mark. You don't want to break that mark. So Nifty Bank at a crucial juncture. But otherwise, in the broader market, Mangalam, a lot of stocks moving around. IRB Infra, Suzlon, BEL, big recovery from the low point of the day. HCC as well. So quite a bit of action from the broader markets.
Quite a bit of action from the broader markets. The index, don't be fooled by the flattening of the mid-cap index itself. A bunch of stocks doing well. And the FMCG index actually has come back today. We were speaking about HUL at the start of the show. Just look at Godrej Consumer. That too is up around 2.5%. Marico's breaking out. We have a big move on Dabur is what we're seeing. Tomorrow, the biggest of them all in terms of weight comes out with their results. We're watching out for ITC results. And alongside that today, we have a bunch of other broader market results from the consumer space as well. Jubilant Foodworks, there's Nykaa. We also have, a bunch of others reporting their numbers too. Indigo Paints, for instance. So we'll keep an eye out on all of them. And we will take a short break, come back. On the other side, we have the team of, all right, we have Vamakshi joining in with us. Vamakshi, you're tracking BHEL, right? Tell us, the stock's down 5%.
Well, absolutely. When we look at BHEL, the numbers are weaker than what the street was expecting on all fronts. When we look at the revenue that has come in at 8,260 odd crores, this is a 7% miss as compared to street expectations. Even the margins, they were expected at somewhere around 14%, but the margins that the company has reported this time around stand at 8.8%. On a year-on-year basis, in fact, margins have declined by almost 400 basis points. When we look at the EBITDA, that has come nearly 43% below the street expectations, and net profit has come in nearly 41% below estimates. The receivables for the company also continue to be elevated at almost 8,010 crores. On the flip side, there is a very strong order inflow coming in for the company. In fact, in the fourth quarter, order inflow shot up by almost 4 times YOY, and in fact, the order book is also at a decadal high for this company. That is a positive for BHEL, but apart from that, the call commentary was also very positive. They believe that 12 to 15% revenue CAGR is what the company could post in the medium term. The gross margins have been on a declining trajectory, and the management says that this could turn around going ahead. They're expecting 10 gigawatts of ordering every year over the next couple of years, and in fact, they also have 80 train sets of Vande Bharat in their order book, which will get delivered by June 2025, and revenue recognition is expected to kick in from there on. So overall, the commentary looks quite positive, but the company has reported a weak set of numbers as compared to the street expectations, and the commentary is not enough to push the stock higher in the trading session today.
Well, Vamakshi, well put and well explained to us. Thanks a lot for that. But we can't let you go at that. We want to hear more. Tell us about Hitachi Energy. The stock is buzzing today.
Well, a good set of numbers coming in from Hitachi Energy. When we look at the revenue, it has grown by almost 27%, and this growth is largely being driven by a solid order execution, diverse revenue mix, as well as focus on continuous improvement in the operations. The margins have also improved for this counter by almost 360 basis points. They now stand at 10.7%, and in fact, the company had earlier given a guidance of double-digit margins by end of FY25, and they've managed to achieve it by the end of FY24 itself. So this is a very big positive for Hitachi, and in fact EBITDA margin is at the highest level for the company since Q1 of FY20. They also have a very healthy order backlog of almost 7,229 crores, and their order inflows have seen an uptick of 11.5% YOY, and on a full year basis their order inflow is up almost 14%, excluding the HVDC order that the company received in FY23. So overall, good set of numbers coming in from Hitachi Energy, good improvement in margins driving the stock higher today.
Okay, all right. Thanks a lot for that. Well, let's move on then. Let's move on to some news that we're picking up. A big block is likely in Star Health Insurance very soon. Abhishek Kothari, he's joining in to fill us in with more details. Abhishek?
Well, sources do tell CNBC-TV18 that there will be a large block on Star Health very soon. It's likely to be tomorrow or in the very near term. $250 to $270 million is the block deal which is likely to happen very soon. The pricing would be around 530 to 545 per share. Now, three PE investors, that is APIS as well as Madison and ROC Capital, are the likely sellers of this in this stake sale. So Mio actually holds about 4.6%, APIS holds about 2.6%, and ROC Capital, they hold about 1% as of March 2024. The likely, book running lead manager is ICICI Securities. So that's the story that we have on board today. Back to you.
All right, Abhishek, thanks a lot for that. Shares worth nearly $250 to $270 million, likely to change hands by a block between 530 to 545 rupees per share. That's stock on our radar. But the RBI's board will meet today to decide on the dividend for the future for the government for FY24. That is, Ritu joins in with the details on that one. Ritu.
Well, there is a lot of speculation about just how much dividend the Reserve Bank of India is going to send to New Delhi, with a critical board meeting taking place today to approve that dividend transfer. Now, RBI is expected to transfer a higher dividend to the government for FY25 compared to the 87,416 crores that was transferred in the year before. And this is on the back of a higher than expected income from foreign securities or the bond holdings that RBI has. Now, we're calling it dividend for FY25 because the transfer from RBI will be for FY24, but it is going to reflect in the government's accounts only for FY25. Now, while the estimates from various economists for this dividend transfer, they range from 85,000 crores to upwards of 1 lakh crore, the dividend is expected to be closer to the higher range, as for most of the economists, because of the sharp rise in the interest that was earned by RBI through its foreign exchange assets, which in turn can be attributed to the rate hikes that were undertaken by the US Federal Reserve over the last 2 years or so. Now, economists estimate that RBI's balance sheet also rose more than 11% in FY24 because of the increase in foreign currency assets, in loans and advances to banks and gold reserves as well. Now, the government has budgeted about 1.02 lakh crores as dividend from the RBI and other state-owned lenders for FY25. So this higher than expected dividend from RBI is going to support the government's liquidity surplus and thereafter expenditure going forward, although the government expenditure itself is only expected to pick up after the elections.
Okay, Ritu, thanks a lot for that. We'll wait with regard to further details on that front. For the time being, we'll wrap up on this edition of Chartbuster. Stay with us. Trading Hour comes up next.